Welcome back to Liquid Lunch. It's me, Hugh, and we got Joe Barbieri, or should we call him Joe the Investor today? Joe, great to have you back on the show.
Yes, how are you?
Good. Always something to talk about because,
Sure.
boy, I watched. You wouldn't believe this, but last night I watched. Niall Ferguson, his fabulous. I guess originally it was a book called The Ascent of Money, and then he did a
Yeah,
4 hour. I don't know if it was BBC documentary on money.
yeah. I have his book, The
Yeah,
Ascent of Money.
yeah, I have it too.
It's very interesting.
It's very
He
interesting.
goes way back in the past.
Yep,
And
but he
talks
doesn't go
about
far enough. And I don't mean far
well
enough back in the past, but I don't think he goes far enough
detail.
in assigning, where the problem is. Because I think he closed the doc by saying that we have to find the right balance between the amount of debt and the amount of. But to me, the whole interest thing is completely unsustainable in the long run,
Hmm.
as Europe is finding out.
Yeah, that's one of today's topics.
So we got a couple topics today. Let's just say what they are first. Europe is one of them.
Europe is one of them, and J.P. Morgan is the other one.
J.P. Morgan, the bank,
The bank.
not the person who founded the bank. J.P. Morgan, who
No,
ruined.
it's the last week's news. 'Cause
Okay.
there's been a lot of news on both of those
All
this
right.
week.
Which one do you want to start with?
We'll start with J.P. Morgan.
Okay, J.P. Morgan.
So,
All right.
have you read the news of the last
Was
3 or
it
4
was this
days?
about they made a $2 billion
$1
loss or something like
That's
that?
it. Yeah.
And what's the situation there? What happened? Bad derivative trading?
Well, it was a bad trade.
Yeah.
Now, all the news is about trying to find out why. It happened fairly quickly. It was over 6 weeks. That was what the news has reported, and it was on a large position of $100 billion.
Okay.
And I can get into the details of what it was, but I don't think it really matters
Well,
because I think it's a symptom of a underlying thing that's happening probably in all the banks.
okay.
In that, well, the issue that's in the news now is risk management.
Mhm.
How is that allowed to happen? Was anybody watching it? Can it happen again? These are all the questions being talked about. Should they be regulated more? And even the politicians are asking those questions now in Washington because of this $2 billion news item.
Mhm.
And so just to run down on the risk, and this has been in the news too, what the company does is they take all the trades in the in the whole company, and they aggregate them all, and they figure out a risk number for the whole company, and they call it value at risk, or VAR, and that's what you'll see in the news, that they restated the VAR number, and that was sort of leading up to what happened this week.
Okay, I'm not sure I understand. So this VAR number. So what does that mean? Does that stand for something? VAR?
Value at risk.
Okay.
So what it means is if we put so much money into a trade,
Mhm.
with such and such a probability, we'll lose this much money. So it's trying to assess how much possible loss there is on all the companies trading. So this is a way to manage risk. It's a method.
You mean the trade, this type of trade that they made, that they lost $2 billion on, is really a way to manage the risk? Is that what you're saying?
Well, this method I'm describing is trying to manage what can happen if the trade goes wrong, basically.
Okay, so you're talking about a strategy of dealing with this kind of huge loss
Yes.
of a trade?
Of alerting people that yes, if you take too much risk on your trade, then you'll cross this threshold that says,
So this is a strategy you're advocating? Or is
no, this is what the news is talking about. This is what J.P. Morgan's been using to manage their risk,
but it didn't work?
but it didn't work because there was still this type of loss, So now there's questioning about should this method be used.
So in other words, they stayed within the rules. They stayed within their policy or whatever rule that was going to mitigate this kind of loss, and yet they lost the money anyway. Is that what you're saying?
That's what it sounds like.
All
Now,
right.
now what I'm bringing forth now is to say, does this rule actually work? And a lot of people say it doesn't.
Well, it didn't work in this particular case. Is this rule, is it an internal rule of the company, or is it a rule that's applied by regulators?
It's an internal rule.
Okay.
The
All right.
regulators know about that rule, and
Mhm.
they're debating whether to use that or some other rule, and they're trying to revamp the regulations now. Since 2008, they've been talking about revamping them,
Okay.
and this is another chapter of that story.
Now, is this related to derivatives? This trade, this particular trade? Could we talk a little bit about what exactly happened in this trade, or what J.P. Morgan is
So
saying,
what they did is, it was a hedge. Now,
which are supposed to help you avoid
a
risk?
hedge by definition is
Yeah.
supposed to cover all the scenarios, so that if something were to go up or down, your losses are contained within a range.
Right.
And if it's a perfect hedge, there's no loss. It's completely canceling
Covered.
each other out.
Right.
So this trade was called a hedge, but I'm kind of wondering if that's really true or not. So that's the first part of it. They bought two things that were supposed to offset each other. One was an index.
Mm-hmm.
It was an index of certain bonds,
Mm-hmm.
and they bought some other derivative to offset that index. So if the index went down, this other derivative they bought were supposed to go up, and so the two of them were neutralized
And mitigate the risk to
And mi-
J.P. Morgan.
and
Yeah.
mitigate the risk.
Yeah.
However, in spite of that being set up, this loss still happened.
Mm-hmm.
So now the question is, was it really a hedge?
Yeah.
Is it effective or not? Are they saying everything? Like, is this, do we have all the facts yet? I don't think we do.
Well, is it, now here's my impression, and correct me if I'm wrong about this, but part of the problem is that, and we saw this is what happened in 2008, is that the lenders or the banks, and J.P. Morgan is a bank, right? They're getting further and further away from where the real action is, and what I mean by that is that in the old days, you would go to your local bank who knew the community, and they would lend you the money.
Yeah.
And you would pay them back, and they made that loan based on the fact they knew you, and they knew you'd pay them back, and they knew the situation locally, and the likelihood that economic was going to be stable enough, whatever. Now what happened in the 2008 meltdown in the U.S., people were lending these loans to people, then those loans were being bundled up and then sold to like banks overseas who didn't really know anything about the people who were borrowing the money, didn't know anything about the communities, and because those local lenders were able to pass the buck to a bank in Iceland or whatever, they had no incentive to make sure that loan was actually a good loan and had a high probability of being paid back, because they were able to pass that buck, that hot potato, along to a bank in Iceland. Seems to me this is almost the same thing, where the banks today, instead of making money by making good loans, prudent financial decisions and investments, are almost like playing a casino, and that they have an opportunity by placing a bet in, it's essentially a bet about whether the market's going to go a certain way or an index is going to go a certain way, and they have the opportunity, the potential on the upside to make huge money for just doing one little trade or transaction. But of course, the flip side of that is they can make a wrong trade and bankrupt a company overnight. Is that accurate?
Well, that's some of it.
Mm-hmm.
I mean, what I'll add to it is these bets are leveraged. So if I had $100 and I bet $100 on an outcome, and I paid in cash and I lost $100,
Yeah.
that's the end of the story.
Yeah.
If I have $100 and I
Mhm.
borrow $9,900 from someone else,
Yeah.
make that bet,
Mm-hmm.
then I lose. Now I'm down $10,000,
Yeah.
but I only put $100 of my money in it,
Right.
and that 9,900, whoever lent me that, I have to pay them back.
Mm-hmm.
And if I don't have the money to pay them back, they're out that money.
Mm-hmm.
And where did they get that money? It'll be from another person, because in our banking system now, everything's connected,
Mm-hmm.
and all that money is borrowed. And so that one loss cascades into
Everything.
a
Everybody
bunch of
loses
losses for
then.
everyone involved in it, which will end up being everyone, because these are big, big banks.
Well, we know what happened in the U.S. was that the banks got bailed out by the taxpayers. So the taxpayers
So that's
ate
the everyone.
that, right? I remember when I was a kid, I used to ask my dad about the what caused the depression and that sort of thing, right?
Mhm.
And he would make a comment like that they had margin,
Yeah.
and that's and so people would borrow 10% to buy they'd only have to put 10% down to buy a stock.
Mhm.
And so that's the same scenario that you're describing. And that after the stock market crash, they removed margin. It goes
Mhm.
back to the point you're making, where if you're not borrowing that money, then you just lose your $100. But when you're borrowing, it's in the long run, nobody wins. Everybody loses this way. Why? It seems that the lessons of the depression have been lost, and that everybody's like, hey, let's have margin in it. That way we can make more money, but you can also lose more money, and you're going to make the whole system more inherently unstable.
Well, yeah, I think that is happening, and we're now we're very unstable now. If you look
Mhm.
at the news releases and how the markets are reacting, and
Yeah.
the volatility, and there's a lot of people just not bothering to invest because they're afraid.
Yeah.
Those are all signs of maximum instability.
Okay.
And so this thing that JP Morgan did is just a symptom of all of that.
Right.
And 2008 was a bigger symptom, and the other crashes were other symptoms. And it's like you have a swamp, and the alligator pokes his head up every once in a while,
Mm-hmm.
but they're always under there. You
Mm.
just don't see them. And then when he pokes his head up, you're like, oh, there's the alligator. And so you point to that specific event and say, yeah, the alligator's there.
Yeah.
But under that swamp, there's all kinds of alligators.
Okay.
And I think we're going to see, well, we've already seen a lot of alligators, but there's going to be more of them, because this one happened to go wrong, and it got into the news. But what about the others you don't hear about?
Yeah.
And I mean, JP Morgan's been in the news saying, well, we made a bad judgment call. We had poor management of the trade. But this is the culture of the banks. This is what what they're doing now.
Mm-hmm.
And you're paid to do that.
Mm-hmm.
And I even have a quote in I think it's Bloomberg News that says people are incentivized to take these risks, because that's where the money is. So
Where the big money is.
So if you work there,
Yeah.
you're almost compelled to say, look, I can do my conservative loan for 5%,
Yeah.
or I can crank the leverage up and make 100%.
Well, and this is just it.
And if you're being paid on your performance,
Yeah.
or how much money you make,
Uh-huh.
you're going to be compelled to crank the risk as high as you can without getting caught to 100%. And you're going to make a mistake, and then boom, you'll be in the news.
And if you don't make a mistake, so the bank's up $2 billion.
Nobody
by
would have
making
heard about
by
it.
making a trade that nobody heard about. But I mean, just think about how wrong that is in the long run, because as opposed to making 100,000 mortgage loans to real people who are going to pay for those houses, how much easier it is to make one betting transaction like this that may make the bank as much money as lending 100,000 mortgage G's, or losing that money and ruining the bank. And it just seems to me that we are getting, and the banking system especially, getting so far removed from the reality of
Basic banking.
of real finance, real economics. And even when you go to, there's a lot of people the real unemployment rate is higher than I think it is. But
Yeah.
and when you go to I don't know what are bank fees now on a bounce check. I don't know, $20, $35, something like that.
Something there, yeah.
When I think about that, $35 for a bounce check, and sometimes how hard it is to make $35 in the real world, and a bank just says or slaps on that fee of $35, it's because they're living in a they are that far removed from what's really going on in the economy that even the banking fees themselves are too high because the bankers are too far removed from what it really takes in the real world to make $35 worth of stuff. Okay, so that's one of the alligators that's poking its head up is the JP Morgan thing. But do you have any final thoughts on that, or any even recommendations, or anything else you want to say about that before we move on to the next one?
Well, I'm watching to see how this develops. I mean, the regulators are investigating, and that's going to happen. There will be an ongoing stream of news saying we found this or we didn't find that. What I'm looking for to see if anything changes, and also to see how many others crop up. But I'm expecting there's going to be more.
Yeah.
And what to do? Well, this actually doesn't change anything because it's always been under there and it's been there for a while. And well, if you're a local person, you can deal with a local bank. And that's the banking end of it. If you're in the stock market, you'll have to be very conservative about where you have your money, but that goes without saying. People are already saying that. There's not really much else you can do specifically for that. It's more to be aware that things are going on in the banks and you don't know about all of them because a lot of them are proprietary and confidential, and only when something blows up will you hear about, oh yeah, we missed this one and therefore somebody got fired or a regulation rule will be changed,
Interesting.
etc. And that's how it's going to play out. People have already been fired in the last couple of days.
All right. So we'll have,
So expect that type of pattern.
yeah, maybe the CEO should get fired for allowing this thing to happen, rather than the lackey who's operating under their supervision.
People well, they haven't actually said fired, but they've said, is this going far enough? Which, can imply.
Interesting. There are, natural checks and balances, including, how the shareholders feel about this kind of stuff. So we'll see what happens. Shareholders, regulators, the market itself. Okay, so let's talk about one of the other alligators, and I guess that's Europe. And because we've seen, didn't the stock market take a bit of a dive yesterday?
This week.
This week. And is that because of the what's going on in Greece?
Yes.
Okay. So
now what's different now? Greece has been in the news for a while. Yeah, they're going to leave the Eurozone. They've been talking about that. One subtle change, they're openly talking about it. Germany is openly saying, maybe, if Greece leaves, it's not so bad. Or if we want them to stay, but it's up to them to pay the bills, and if they don't. And before, that was absolutely not said. It was, no, we made a deal, they're going to pay, it's, we're all in it together and we're going to work. But now you're starting to hear people say, well, we're in it together, but if it doesn't work, oh well. I think we can manage, So that kind of attitude is saying, okay, they're preparing for something. Before they might have been preparing, but they didn't tell you. Now they're starting to tell you. The other thing about Europe is the political scene. It's dramatically shifting. With
the election in France and Germany too?
Germany was the latest one.
Yeah.
Well, Europe was fairly socialist.
Yeah.
In the past.
Yeah.
Then it began to go to the right, the hard right. And that's showing up in the immigration news in Europe. And with the austerity measures and bailouts are hard right. Slash costs, reduce the debt, etc., etc. Now, these last three elections, it's swerving to the left. Well,
Okay.
the French said, no, we don't like all this stuff.
Mm-hmm.
We're going to vote for this Holland guy
Yeah.
who's talking about raising taxes
Mm-hmm.
and pro-growth, which means spend money
Mm-hmm.
so that the GDP can get bigger and
Mhm.
that'll pay off our debt,
Right.
which is completely the opposite of the austerity measures. It says cut everything and in time we'll catch up.
Is that what Sarkozy was doing?
That's what he was doing.
Right.
And the Greeks had somebody who was also pro-austerity, and he lost his majority, and now they have a fragmented government, which means they're not really sure what they're going to do. But the person who's in the lead is the opposite end, saying we don't buy this, and we're going to reverse all of these things that we had promised in the deals.
Mm-hmm.
So that attitude is completely opposite of everything up till now. And so that's telling me that the voters have always been disgruntled,
Mm-hmm.
but now it's getting to the top of the political chain. And so some of the leaders are they're reflecting what the voters have always been saying. We don't like it. We don't want to have to suffer all this. And so now it'll be interesting to see what happens in Europe as a result of this. Are they going to reverse all the austerity measures, or are they going to continue to? And if they don't reverse them, will the protests increase?
Well, here's the thing. Like, I mean, this is an interesting discussion because it seems to me what we're really seeing, what's really going on, and in fact, there was a big article in the Globe about what Germany should do. Who wrote it? Doug Saunders, I think. Did you read that article? I think it was Doug Saunders. Anyways, that Germany needs to spend more because I guess Germany's not really spending a lot of money, right? And so Doug Saunders' solution to the whole euro crisis is for the Germans to spend more and buy more products from Greece and Spain and the other
So
euro
that's another-
economies that are in trouble. But I wrote a response back basically saying that, you're thinking inside the box. And the real solutions are way outside of that little box, because what the real long-term trend that's going on here is that debt levels, public and private, are going up and up and up. Maybe not in Germany so much, but certainly in these countries that are in trouble in the Eurozone and all around the world, frankly. What are the public and private debt levels? Higher than ever, right? And so that money has to be paid back with interest. And governments look at that, governments that have large deficits that they use to pump up their economy, keep people employed, build infrastructure, keep social services going. Now they have to pay that money in interest on the money that they borrowed, and the only way to do that is to cut all that stuff. So the amount of interest that these countries are paying is higher than ever, and the only way they can afford to pay the interest is to cut real services. The real problem in the long term is that the debt levels are unsustainable, and they'll always be unsustainable because it's compound interest, and where's that money going to come from? The only way place that money can come from, because all the currency is only created as a debt, is by creating more debt, which means more interest. And interest is money that's going to bankers that could have been going to people who are doing real things in the economy, like building infrastructure, doing social services, right? The interest is for what? Nothing. That's the real problem, and the real solution has to be outside of that. It has to be a reinvention of the money system. I know I'm going too far now, but
Well, I mean, that's essentially what's happening. Now that person who wrote about Germany is kind of saying what Holland is saying. Let's just spend our way out. And I believe what's underneath that, the austerity measures aren't working, and you can look at the statistics. All the debt is still going up in Ireland and
of
Italy,
course.
in Greece, even though they've slashed for years, 2-3 years.
And we're doing it here in
GDP
Canada
is,
too.
is very bad, and we're doing it here.
Yeah.
And our debt is really not going down.
No, it's
They're
not.
saying 2016 or 2020, but they were saying that 20 years ago, and we're still here. So.
And the IMF is here in Ontario telling Dalton McGuinty that he's got to cut stuff, sell off public assets, cut social services, cut education,
It's an old pattern.
and yeah,
They
and
were,
now,
they were doing that in the 90s, I remember that. And the services were never restored. What was cut then, and it's been cut further since.
and even the protests in Quebec are really, it's part of this same problem.
another
The
symptom of
government
this.
is trying to cut, make the students pay more for their education, and the students in Quebec, at least because they don't put fluoride in the water, are saying no,
Yeah.
right? So Joe, what's going to happen?
That I don't know.
Well, we need
It really it really depends on what the people do. I mean, we could have huge riots. We could have debt forgiveness. We could have hyperinflation. We could have deflation. It really depends on which way the tide blows. But whatever's happening now is not going to last for 20 more years. Something's going to give. And it's a matter of who will do the giving and how much awareness will there be with everybody. I think the awareness is going up of all of this, like the debt levels, the austerity, the
Yeah.
whole big picture, which
Mhm.
20 years ago, if you came out and said, it's all about the debt, they'd say, well, we'll just go away. But now a lot of people are saying it is all about the debt. This other stuff is just covering up, and we need something that is outside the box,
Mhm.
outside the Keynes box, outside the old paradigm box, outside the print money box, etc., etc., etc. Spend your way out. I've heard that for a long time, that, well, if you just spend money, everything's going to be okay. You'll be a good patriot.
Mm-hmm.
And, I mean, the States tried that. Let's just spend our way into...
Well, they really
But-
haven't.
But they're not really coming back, so... And, now they're saying that in Germany and France, and it's like... If it hasn't worked in the States for 30 years, how can Germany turn it around there? So these are all the same patterns.
Mm-hmm.
And I think what is going to happen is people will start going out of those patterns and saying, we really do need something different, and we're now ready to do it.
But who's going to implement it? What politician has the solution
Well,
that they can implement
The
legislatively?
people will have to push them to...
But even if
to
somebody
implement.
announced they have a solution today, who's going to believe them? And part of, and I'm not trying to be negative here, but even you mentioned outside the Keynesian box. Well, when Keynes came in, we know about Keynes now, and we accept that
Back then he was outside the
he had
box.
the right idea at the right time. But at the time, he had to convince everybody that this was
That's
the
right.
solution, because before Keynes came along, the government said, "Oh, we got an economic problem," and they started behaving like households in the microeconomic sense and withdrew spending from the marketplace, which was exactly the opposite of what Keynes's prescription was, right? So, Keynes was outside of the box. We need somebody now to come from outside of the box with a solution that can be implemented and fix the problem. But it's like inventing the next social network. You don't really know who it's going to be until they've
Until-
achieved the success
until
through.
you're in it.
Yeah.
Which is, yeah. But because of what's happening, something is going to give somewhere. It isn't going to be more of this.
People talking about the hyperinflation possibility of that, and we saw the U.S. Fed inject, theoretically at least, billions, maybe trillions of dollars over the last couple of years, but that money doesn't seem to be hitting the street, and
Yeah.
so at the street level, there's no inflation. I mean, that money's all, I don't know who's circulating that money,
It's
but
inside the banks.
it's in the
right
banks,
now.
and it's just
Mhm.
numbers on computer screens. It's not on the street, which has kept inflation from going crazy. But and people, money's it's a tight money situation for a lot of people on the street. But could that change, or is the system so different now that even though all this money is being pumped in theoretically, it's just not going to hit the street?
Well, I think eventually it will.
Yeah.
Otherwise, well, how I see it is, if it indeed is created, it will have to be on the street.
Mm-hmm.
They might be pulling a bluff and say, yeah, we pumped $3 trillion in, but we only gave it to 3 people, and the 3 people are sitting on it.
Yeah.
Well, if money doesn't circulate, it's dead.
Yeah.
It doesn't do anything.
Yeah.
And I think that's really what they've done.
Mm.
Here's $3 trillion to tell everybody, yeah, look at all this money you're going to get, but 3 people sit on it. So where is it? I haven't seen it. And I think the common person is saying, where is it? I haven't seen it. I can't pay my bills. I don't have a job, this, that, whatever. So I'm just going to do what I've always done. And so nothing's changed. And
Okay.
so I think it's more of a psychology
Yeah.
event than a real event. But in a flick of a switch, that money can hit the street, and then you will get all the things that happen after. So
Well, the good thing is you might actually get some people doing some stuff we need, like helping people or teaching people or building roads and infrastructure. If the money hits the street, maybe we can do some of that. But whether there's the wisdom at a policy level to do that, I don't know. I guess we'll have to wait and see.
Yeah.
All right, Joe. So we don't know what to expect. The markets, how are they doing today? Do you know?
I don't know, actually.
All right. So they've been down. They were down yesterday over the Greek crisis, and probably a bit over this J.P. Morgan thing too. People.
The bank sector was down.
Yeah. Okay. I guess we'll just have to keep our eye on the ball and keep having you back here on the show and to stay on top of this stuff. But in the meantime, people can get in touch with you, right? If they want help with their investments or anything else like that.
Yeah. My website is joeltheinvestor.ca.
Mm-hmm.
And I also have a second site, www.joeltheinvestorgroup.com, and all my contact information's there.
JoeTheInvestorGroup.com.
Group.com, yeah.
Okay, Joe. Thanks, as always, for having this conversation.
Yes, thanks a lot.
Okay, so let's take a little break. We're going to come back. Sean Dalton is in the house talking about immigration, and we'll be right back here on Liquid Lunch.